Liberalized Remittance Scheme, LRS. Now, what is so unique about it and why it is different? Now, this has been an interesting scheme which has been released under FEMA 1999 and brought into effect from 2000. The caps had been changing, and recently it was in news because you have new caps and guidelines that have come up. So, what basically it is, all the resident Indians along with the minor children would be allowed to freely remit funds, and this would be up to 2,50,000 USD dollars. Now, this fund could go towards foreign education, travel, it could go towards foreign securities or purchase of property outside India. Again, this concept or this remittance, the liberalized remittance scheme is not available to corporations, not available to HUFs or Hindu undivided families, not applicable to partnership firms or trusts. Now, this remittance that is going in could be clearly divided into two segments. Those are the current account transactions and the capital account transactions. So, capital account transactions and the current account transactions, what are the different? Under the current account transactions, the residents do not alter the assets or the liabilities, including the contingent liabilities. So that means the money is going towards, let's say, foreign travel, foreign education, or it could be in connection with foreign trade. However, when it is capital account transaction, there are cases where the person's liabilities and assets are outside India and they are altered. So this could be in the purchase of foreign securities, purchase of immovable property outside India. So that is capital account transaction. So this remittance is applicable to both the current account transaction as well as the capital account transaction. When we talk about remittance, we said resident individuals. Now, what is the definition of this resident individuals as per the taxation? So, under taxation, we say an individual residing for a period of 182 days or more is considered as a tax resident. However, recently this norm has been changed under the recent Finance Act and it has been brought down to 120 days. Now, the idea is of reducing this to 120 days is government is trying to bring in or trying to seek taxes on NRIs who are carrying substantial economic activities from India. Now, this is a very important development that has come in line. Also, when we talk about the recent changes with the remittance scheme, the major idea here is the tax collected on source above 7 lakhs would be tax. So there would be tax collected on source above 7 lakhs. So that means, let's say you are transferring 10 lakh rupees. Now that 10 lakh, you just subtract 7 lakh because up to 7 lakhs you do not have any tax. So you remain with 3 lakhs. Now for this 3 lakhs, there would be a 5% tax that would be calculated. So 5% of 3 lakhs would make it 15,000. That means 15,000 would be tax collected on source. So it is on the source. That means the payer has the liability to pay that tax, not the recipient. So again, very important, one who is paying the remittance would be liable for the taxation purpose. To make it smoother, all the PAN details are made mandatory. As we said, this is a kind of legal procedure lying under the FEMA Act, and that is the Foreign Exchange Management Act, which was brought in 1999, implemented in 2000, and therefore is very, very important and is applicable to both the current account transactions as well as the capital account transactions. So that was a very key highlight, a very important and probable section for your upcoming examination, because this is a recent change that has been brought about, a 5% tax collected on source above 7 lakhs. So we would be covering many such important highlights for you. Stay tuned. Have a wonderful day ahead.